Isso aí em cima não dá para eu passar.
Aqui, consegue?
Aí sim. E também.
Hello. Bonjour, mon amis. Comment allez-vous? Here's a big question today. Are you going to watch Mueller, Draghi, or Face? Can you watch all three at the same time? Who's going to be watching all three at the same time? Who's set up for that?
Draghi's tomorrow, coach, right? ECB.
Oh,
Good morning.
okay.
So it's a dilemma. Only two now.
Not as challenging. Anyway, Paul would watch Face even if there were three. So I mean, don't we have dedicated people that are here every day? And we thank you for being here, Paul, and everyone who comes here. And it's our mission to build up and edify everyone in here every day. So we all hope, the whole team hopes, that we're adding value to what you're trying to accomplish as a trader. But okay, here it goes. Here's a pitch. I mean, this is just the first step, right? I would immerse myself if I say, for example, I've been trading for about 3-4 years. I'm starting to get the hang of things, but I need to make some breakthroughs. And you always need to make breakthroughs. I'm still looking to make some breakthroughs, and I've been at it for a little while. Hello, Andre. And the best way to do it is to surround yourself with traders that might be a level or two more proficient than you, because you become who you hang out with. You ever hear the expression, be careful what kind of friends you pick? Okay, so that applies here too in trading. So, use your discernment and hang out with guys that, you admire, that you'd like to learn from. And really, this is a pretty good deal. So let's look at some pricing here. Okay. So let's say you went all the way 12 pips, tier 3, 11 pips, 11 pips, 10 pips on one trade. And, I know Andre was on it. I know I was on it. I heard Steve talking about it, with 91 stops, right? Everyone know which pair I'm going to go for? Call me a broken record. Take a guess. What pair am I going to go to, guys? Anyone want to make? Yeah. Yep. So why do you guys know that? Because you've been hearing us talk about this forever. Bitcoin's gone to 7,000. So last week on the throwover and the divergence at 51. So yesterday I went over where stop hunts might take place. But just a one lot from here, anywhere in here. And even if you sold, I showed the 50% retrace here, that was up around 90. There's 85 pips. That's on a one lot, that's 850. So really almost pay for your whole year subscription with just a one lot on. And, it's not something we just glossed over. Andre presented the harmonics, Steve with his basic technicals. We felt this 85 and a half level is going to give way. So, we finally took out this stop. Yesterday I pointed out, I think we take out this stop. So that's done. We might get a bounce from here. I don't think it's done. I think that these lines will end up being magnets. And I really think before it's over, we're going to see 87. Because that was such a important pivot. That might be aggressive, but I think we could see that. And then we'll see 94, 95. So to me, this is counter trend. Here's a weekly. And I don't know how long I talked about it over the last year. Okay, over the last year, I said this formation was incomplete. Steve and I were argued over nothing. But for Steve and I, that's fun. Okay, we have fun having different views. I had my bias. He had his bias. But I'll tell you something about Steve. Once it did this, he saw it. Okay, so a lot of people were trapped down here. Now I think a lot of people are trapped up here, and I don't think it's done. There could be a reaction, but I don't think it's done. So actually, I was looking to do something in the S&Ps. If it sets up, say, for example, people say, this is a dud, this Mueller testimony, right? And we get one more shot up in the S&Ps. A lot of people are, and I still could see it happening, that we get a new high, 30, 40, 30, 50. I think Steve has some fibs up there. Real possible, maybe into month end or so. But, we could also still pull back to 2920, and if we got through there, 2800 and then blow to a new high. So with that being said, I'm really drilling down on a short time frame. Don't tell my mentees. They know. I look at 15-minute charts sometimes. Yeah, Andre, A, B, C, D, possible bounce in EG. So Andre agrees that there could be a bounce in EG from here. And Steve Harjo wants to thank you for your Euro Yen short idea. So see what I mean? Let me ask you, Harjo, are you a subscriber? Just curious. Not yet. Well, today's the day then, right? Oh, well, how do you think you're going to get to trading bigger lots? All right, so maybe it's not economically feasible for you to spend $100 a month. I actually think that, and I know I get blowback from a lot of people, and it's okay to start small and everything, but I was brought up with regulations in the industry, and you guys, can do what you want to do, but there's this thing called suitability to trade that as a broker, you had to make sure people were suitable to trade. That means that whatever they're trading with is really risk capital. And I really think if you're trading with less than, okay, I know it's going to, upset some people, less than 10K, and you can just flush that and it won't affect your lifestyle. It's not your 2 months of your mortgage payment or anything else. And before people would open commodity accounts with me, I would say, I want you to visualize that check you have for 10K and visualize, strike a match and light it up. And if that makes you nervous, if that money could be gone, it's not risk capital. So that's your acid test. Ask yourself, with what you have in your account right now, if it all disappeared today, would you and your family be okay? And if the answer is yes, it's risk capital. But if you notice, it takes money to make money. It's easier to make 10% with 100 grand than it is with 10, and even more difficult. But we have micro lots, and some people look. Not everyone that goes to a casino plays baccarat. Some people play penny slots if they still can find those machines for the fun of it. I'm just telling you what I've learned and what I've seen, and I really think you need at least 10K to speculate with in these markets. And even with 10K, you should be trading very, very, very small. Trading isn't gambling. Okay? Not the way I trade. It's both. I'm gambling on my trade. Yeah. Okay. So let me just cover a couple other things. So if I got a rally in S&Ps, a lot of people are saying, okay, this, we proved ourselves here and this is continuation. I want to see what it does up here at 78.6 if we get here. So I may short it here and have stops, maybe 5 handles over the high of the move to see if we could get a failing rally. Because if we take out this area and even more importantly, 29.60 with a, 30-20 high, that takes you here, to about 29.10. Okay, and that wouldn't change the bullish picture. And a lot of people will say even a break all the way down to 2,500, 2,400, and I don't have my fibs in the right place anymore. Okay, so that's going to be something I'm going to be looking at. The Dixie, now that we had a breakout, is it going to hold? I think we're going to make a move towards 99.20. I think that was Peter Goodburn's number, I don't know, a year ago. So a lot of people had numbers up around 99.20 and then 102 and the Super Bulls, 104, 107. So for the dollar to remain on track, now I believe we have to hold this right here at 97.40 for a continuation move. We're getting a pop with the yen lower. We're getting a pop in the gold here today. Gold's keeping up pace. No, it's only half as strong as silver. Silver's making another new high, I think. But I was thinking that, I look at this high, give me another high, and you know what I mean, a high in the market. I may attempt some shorts. I thought we could trade 1480. Maybe that happens. We come down from 52, 36 bucks. Tack on 36 on top of this and gets you 1488 or so. So that's what I'd be looking for. Let's see if silver is confirming. Oh yeah, on the daily it is. Let's look at some short-term stuff. Diverging on the 15-minute. This gold-silver ratio has been a bullet. Some divergence on the 1. Some nice divergence on the 4-hour. So we'll see. I'd be taking profits on long silver because I think we could get a pullback to 1570 and still be good, back here. maybe all the way back here. Maybe you don't let go of your whole core. He should be starting right now, Joe. 8 a.m. I think it was EST. Okay, so we could get a pullback to here. So that's about it. Yeah, that's about it. So we'll see. I'm still trying to be patient and waiting for one more flush in the yen. But if it goes, that's okay, because I'm short TLT. And, if the yen does this, gold's acting pretty good for the yen not being much lower. If the yen does this and takes out this low that we had the bounce to major resistance, look for a yen bottom, an important yen bottom, to get bearish on the metals. Okay? And that's a wrap for me. Steve, are you on deck?
Good morning.
Hey, Coach. Good morning.
Hey, guys, how are you? Wow, was there any reason why cable popped today? Boris Johnson parted his hair on the other side?
No particular reason.
They both have crazy hair, those two buddies. There's a bromance between Trump and Boris.
They're so similar. It's uncanny, yeah.
And they both have kind of wild hair, don't they?
Yeah, and small hands.
Good one, still.
Oh man, yeah. So there weren't any big news. No, he's due to first of all, Prime Minister May's. She did her last Prime Minister questions in Parliament, and he is due to make a speech today, and then he's going to announce his cabinet, and everybody's waiting to see who's going to be in the cabinet, because it's going to give a clear sign on how Brexit is going to be handled. And I've been thinking to myself and asking myself over and over again, if I was in the position of the UK and of the Europeans, we have seen so far that the European Union, the people have basically not budged an inch, right? Nothing. And everybody focuses on what the damage is going to be for the UK, and there's it's a good point, because the UK stands to risk a lot. On the other hand, the the Eurozone is going to lose its second biggest economy, so it's not going to be a walk in the park for the Eurozone either. Now, I was thinking, if I was in their shoes, I would not do anything up until the last minute. In terms of if I was bluffing and I was thinking, okay, let's see what they're going to do, if they're going to cave. I'm talking about being a European, looking at the UK Prime Minister. I would just sit there. I play quite a bit of poker. I would be betting every street until the river, until the end, and leave them right until the last minute, because that will put more pressure on them to fold or to make a step back. But I think at the end of the day, I've said it again, both sides, really, the politicians on both sides, theoretically, they want to make a deal. So I think, unfortunately, we're going to go on this until the end, so until October, unless something groundbreaking happens. So we wait for. I'm
not going to play cards with you.
Hey, I'm not
like Matt Damon in The Rounders.
I'm not the best player out there, but I've played quite a bit.
If you love poker, that's a great movie.
Yeah, it is very good. Yes.
Oh, okay.
I love it. I love it.
All right.
So that's happening in the UK. We haven't got anything firm yet. So when we do, we're going to talk about it. So that's one thing. The other important thing that happened today is we had some pretty disappointing data, PMI data out of Europe.
So not so pretty.
Yeah, exactly. Going from pretty Boris Johnson to not so pretty PMI data.
Yeah, German PMI data.
Yeah, manufacturing
drilling for oil.
Manufacturing PMI in France, 50, just above, at the neutral level, from 51.9. German down to 43.1 from 45.1. You have to go back to the crisis, the 2008, 2009 to find this. And the Eurozone overall manufacturing PMI 46.4, down over a point. This is definitely not good news. And Draghi
will be making new highs, guys, with this news.
Actually, I haven't looked at them today. Let's have a look.
Because they were acting better than U.S. paper.
Yeah, they are rallying today. Yeah, they're making new highs. Yeah, they're off the highs of
You
the
asked
day.
about bonds. Yes, they're again at all-time highs, which means
Okay.
Yes.
All right.
there it is. Which
All
means that
Yeah.
bond yield
I know.
should now be something like, I don't know, -40 something.
Yeah.
God, I want to buy like a lot of them so I could make payments on my savings.
Yeah, it's insane.
What a crazy thing. I mean, I never thought it was even
Insane.
possible for most of my life that I would have to pay someone to hold my money.
Yeah.
You know what I mean? How about you guys? You ever
Aye,
think about it?
there are even better things and ideas out there, like the perpetuity, like the zero yielding perpetuity.
Yeah.
Oh,
So you give your money, you get back a perpetual bond that pays you zero, a coupon of zero. How does that sound? So in essence, you gift your money away.
Yeah, I mean, the alternative is, where do you have your money otherwise? In a bank account somewhere. So basically, maybe people are scared that banks are gonna, depending on the country you live in.
I know it's not that stupid as it sounds, because the theory behind that is that there is always a market, so you can sell back that perpetuity to the market, and if
get
prices,
your money back, get out even.
or even get a profit. I mean, if you get a perpetuity bond, negatively yielding perpetuity.
I see.
But just the idea that if for any reason you are required to hold it, that you've actually gifted the money in order for you to get a piece of paper that says that you're going to be receiving a coupon of zero. I don't know.
Okay, I mean, you studied economics, Steve, at the university level. Did they ever cover a possible scenario in interest rates about them being negative?
Back then, that was not even discussed. You know what I mean?
That's what I mean. Yeah.
Yeah, but back then it wasn't even discussed, because
it's like
because there was still
a real economy,
a sense of logic about how things can work. But now, since there is absolutely no politician out there that is willing to make the proper decisions, which
you better know how to read charts then.
Yeah, which of course the right path is always the hard one as well. What we're trying to do is persuade everybody that this fiscal and monetary insanity in some way makes sense, and everything is going to be all right. And
you have to buy speculative things if you want returns.
You have to buy every year as it goes even more and more speculative things, hoping for a less return. And
I mean, all these new IPOs that were bought up, Steve,
with the huge risk that at some point, while you're attempting to do that, the whole Ponzi scheme is going to explode in your face, and you're going to be left holding the bag. You know what I mean?
I mean, these IPOs, including Uber came out and said that they don't see becoming profitable ever.
Ever, really?
Ever.
I mean, I understand not being profitable for some years, like Amazon wasn't profitable for some time. Wow.
Yeah, I'm old enough to remember the days that companies were created to make a profit. Now, how come we've ended up, considering that optional? I have no freaking clue, honestly. No freaking clue. I mean, it's like, temporarily, you live in a planet that gravity has been suspended, and, you're trying to get reacclimated to a reality that laws of physics just, for a period of time have stopped working. And now everybody around is like, come on, we haven't had gravity like for 1 minute. I mean, why not have it forever? And we always know how that ends, right? I mean, there is no question about it. It's not
Isaac
like
Newton came up with that.
There are several people that know what's happening out there. Our previous guest. I know I keep pounding this poor guy, Kip Heritage or whatever he is. I mean, out of curiosity, I've kept monitoring his tweets. This guy is so bullish on the economy. What makes me mad about those people is I have absolutely nothing with people that are bearish or bullish anything, because there is always a case to be made. I have problem with people that trying to excuse their bullishness on something based on fundamentals, based on fundamental fictions, right? So it's one thing being bullish and having like a theory that we're gonna expand even further this monetary insanity, and that's gonna keep everything beat for a period of time, which is absolutely likely. There's no question about it. It is likely. And it's another thing believing that like we have the best economy ever, and I'm not only talking about the US now, I'm talking on a global scale, right? I mean,
for some reason he believes that the order of globalism, global trade, this and that, slowed us down, and that nationalism, which I don't understand, is bullish for national economies.
So
that's what I get from what I read from.
Okay, let's assume that is the case. Then the worst, if that is the case, let's make an assumption. Okay, let's begin by making this an axiom. Let's say that yes, we accept this is an actual reality and not debate on it. Then the current developed economies are the worst positioned to benefit from that, by far, because they've given away their ability to produce long time ago, based on the fact that due to globalism, they can export, for example, IOUs and receive tangible assets. So if that is the case, again, this is a huge if, I don't agree at all, but if that is the case, then the new reality would be that all the current developing economies within a few years are going to be thriving, and the current developed economies are going to be in, a huge shitstorm. So
anyway,
yeah, I mean, and I can have that debate any given day, but really, I mean, as I said,
that's a non-confirmation in Eurobonds up there, bro. Just noticing.
Yes, as you see this divergence, I've marked it here on the daily chart.
Might be drive too.
Yeah. Depends. I mean, if we fail somewhere here, that's going to be the third drive, right?
Well, I don't know. We had a 3 drive for one. Okay, that whole pattern ended up being the first drive.
Can call,
we had the pullback.
Like
now
that.
Here we're in 2. I guess it could be 3. And you know what? I want to make this clear. I've seen many just single divergences not give me a 3. And, if anything, Steve, if someone said to me, well, Dale, what would you do with bonds? The only thing I could say is it doesn't mean that you would short it because of this, but it certainly is a warning that the market is losing mo, and it could be a reason to take profits and sell.
Oh, for sure. I mean, if you're looking to buy bonds up here after, this lovely breakout and the continuation higher we've already seen literally a move from 163.5 to who knows where it's going to end. I think it might my target still remains this 161.8% extension at 176. So assuming that something like that happens, which is very likely, I mean, we're not that far away from that anymore. We will have seen a move from like 163 to 176 without any real pullback. We just had like a little period of consolidation here and a very tiny pullback here. So yeah, buying bonds here makes no sense. I mean, I would like to see sooner rather than later, like a deeper pullback to be a buyer again. I'm not saying that it's not bullish. It is, and it remains bullish. And, seeing the outlook out there, I see no real reason why the bonds would reverse lower anytime soon. I mean, central banks are just starting again to starting again. That's actually the wrong way to put it. They are about to accelerate once again the pace of monetary easing. So, bonds should remain extremely well bid under normal circumstances. But at some point, when the market is too one-sided, you get some type of an event or technical, fundamental, or a combination of the two, and you see some kind of a pullback. So weak longs can get out of the market, some profit taking to take place, and before you can load the boat up once again. There is obviously clear divergence, as you mentioned before, with what the treasuries are doing here. Treasuries are just still consolidating below the lows. And this is, obviously, this divergence is what is responsible mainly for this move lower in Euro USD, which is about to threaten 111. Now, I very much doubt we're going to break below 111 pre-ECB. But there is a very, very good chance that we're going to break 111 post-ECB, right? Probably during the press conference or something. So, yeah, Euro USD still looks weak. DXY still looks very, very well bid. And I think that ahead of tomorrow's meeting, likely a consolidation, but following that, I see no reason why the DXY can't clear this 97.70 horizontal resistance area and continue higher. And there is nothing else I wish to add having to do with the euro and the DXY. I've been saying the same since the weekend. Now, you mentioned, and for people that are on the chat room, I took a live trade on that. When was it? Like yesterday, was it, or the day before yesterday? Have to check my account. Anyhow, I went short. Oh yeah, yesterday when Boris Johnson was elected. Yeah, I actually shorted it yesterday because I remember it was when we got the confirmation that Boris Johnson won and he's going to be the new prime minister. I shorted a euro pound at 89.70. I know that I jumped a little bit the gun because I was looking for 89.50 to 89.60 to break down. But following that and the initial reaction lower, I saw that the market is probably going to finally continue lower. So, I just shorted it there with a very, very tight stop loss. I was only risking 0.15%. So it was, in essence, almost a risk-free trade. And yes, it's been working. And as I've said multiple times, I see no reason why it shouldn't, at the very least, make it to the beginning of this wedge and this horizontal support area at 88.50. So nice continuation lower for the euro pound, and I do think that we are probably not done. There is more downside to follow here. Now, my pleasure for the friend that spoke about the euro yen. Yes, the euro yen, I mentioned that on the week ahead video. Euro yen, that was quite a clear technical formation here having to do with the triangle. We are resuming lower. We've already broken to lower lows. We actually closed at what is it? More than 2-year lows, because don't forget that this move here was a spike that lasted only like a couple of minutes. And I do think that we're on our way to retesting that spike low at 118.82. Now, there are a couple of things I want to show. One of them, once again, is the cable. The cable, nice move higher today, but doesn't really change anything on a technical level. And the reason it doesn't is because the cable, let's go to the 4-hour chart. The cable is still trapped within this descending wedge. Okay, now, looks very appealing if it breaks to the upside. As you see, you can even see here a little nice inverted head and shoulders formation. But for that to be triggered, we need to see a move above 125.70, 125.80. So, if we see such a move, I do think that there's going to be some follow through, even from simple position squaring, stop loss getting hit to weak short positions, etc., etc. Until that happens, you need to keep respecting the downside. It is holding up very nicely against the dollar in comparison to the vast majority of the rest of the currencies. Speaking of which, I have to admit that I was a little bit surprised, and I think a lot of people have been trapped here in the wrong side of the market. I didn't trade those pairs because, sometimes you just, I mean, there is a technical event, but you just don't feel so strongly about something. I would have rather traded the crosses. But it is important to note that the Aussie USD, despite having broken the confluence of resistances at 70.30 to 70.50, it got rejected just below the 200 daily moving average, and we're back below this area. And this is probably, I mean, after triggering this inverted head and shoulders formation, this is probably quite a bearish event, because I bet a lot of people were piling in to buy it to see higher prices. And it's still not unlikely to see higher prices, because we haven't posted a lower low yet. But as I said before, we broke above a critical level and the market failed to hold above it. That can't be, such a positive event. Kiwi, on the other hand, is thriving, but it is still holding the equivalent breakout level, which was at 67.10. So let's see what's happening here.
Put them both together, Steve. Aussie Kiwi rallied back to the 61.8 level yesterday.
Yeah, and
got rejected.
Yeah, got rejected once again. That's why somebody needs to be very, very careful having to do with those.
But one more new low. I'm looking for the 78.6 level. Where's yours come in? I'll buy it there.
1037 and change.
Okay.
So
103.74. You mean?
Yeah.
Okay.
So yeah, let's see what happens from here. I mean,
I'll take a shot down there.
No,
risking the lows.
It makes sense, and the way it's depreciating is definitely not impulsive. I mean,
yeah, it's like a dripping waterfall.
Yeah, it's exactly. It's, I mean, low. It's been moving lower since 17th of April. So it's already 3 months, more than 3 months, that it has been dripping lower, and within these 3 months, it hasn't managed to fully retrace this move higher that lasted a month exactly.
Oh, hold on. There's a news flash from Washington. Mueller admits that he dated Stormy Daniels too. Yeah, Stormy. Anyway,
that's his problem, not mine.
Yeah. Anyway.
That would
but
be.
He didn't let her spank him like the president did.
I have no. I don't.
I thought you would like the story.
No comment. No comment, Your Honor. No comment.
Yeah, I don't want to. Yeah.
All right. Anyway.
Aussie yen equivalently has turned lower, but keep in mind this might still be a triangle. So as with the Aussie Kiwi, I wouldn't be so so determined to say that we failed. I am monitoring this triangle now. As you know, having to do with the bullish case scenario, and I said that since the beginning. If you like it to the upside, I think buying a breakout from 76.20, 76.30 makes sense any way you slice it. You trigger an inverted head and shoulders formation, you begin at least one more leg higher. So would be looking good. Now, if we fail from here and we never see another leg higher, it's not going to look good, because in essence, we will have attempted several times to break above the first horizontal area of resistance that there was on the chart, and we will have failed miserably to do so. And that is never something good to talk about. Now, Kiwi yen also yesterday, quite a big rejection from there. But keep in mind that as with the Kiwi against the USD, this is also holding above this horizontal support resistance area. So I want to give it a little bit more time before I read too much into that. Another pair that I was looking at, and I think is very interesting, is the USD NOK, because as you see, the USD NOK made another attempt to break back within this broken purple ascending channel. And so far, what we're getting is another rejection from exactly the same trend line, previous trend line support of the channel, acting in this case as resistance. So, the possibility of another push lower towards 840, which is like a super important level for the trend is not dead yet. In fact, against this trend line, showing against today's and yesterday's highs, there is a very appealing risk-reward trade to the downside. Okay, for whoever is willing or to take it or likes it. But keep in mind that if we break above there, then we should probably resume higher and probably finally perhaps even post a new high, because keep in mind that if you look at the big picture, what is the big picture? The big picture is that since November 2018, USD NOK has remained trapped within the 840 to 880 rectangle. Okay, so this is, in essence, this is a prolonged range. I mean, it's already almost like seven to 8 months now that we've been trading within this tight range. So at some point, one way or another, this should break, and theory and experience indicate that when that happens after such a prolonged, trade within such a range, we should extend one way or another. So I think there should be follow through once we break out. Either that's above 880 for a continuation higher, or below 840 for a reversal lower. Okay. Now another pair I'm watching is USD Swiss, which, despite Euro USD almost testing the lows, as you see, the USD Swiss is still trapped within this expanding triangle. In essence, it's moving in correlation to the Euro USD more or less, and the pair to blame for all that is the Euro Swiss. Right, Euro Swiss testing support here, but it still looks very, very heavy. So all of those are going to come in play tomorrow. That's why I'm focusing more on them, because tomorrow we have the ECB, and definitely tomorrow we should see quite a lot of volatility for all those pairs: the Euro Swiss, the Euro USD, the DXY, obviously, since at a big part it's Euro USD, and USD Swiss, and the Euro Yen, of course. So if Draghi talks down the Euro directly or indirectly tomorrow, Euro Yen should continue lower to tag that target we were talking about, that spike low at 118.20 something, whatever it was. Let me go through some questions. With Boris and Donald being in power at the same time, do you think the cable will become very neutral? I kind of doubt it. I mean, they have some similarities, but I don't think that they're about to influence in a similar way the equivalent currencies. And I mean, keep in mind that those two countries are at a very, very different positions at the moment. One way or another, for example,
we have the big binary event coming, right? I think
exactly.
sterling is going to move either way.
One way or another, we have the Brexit event, which is unavoidable. I mean, one way or another, we're going to have to, sooner rather than later, get some kind of a resolution, and whatever that is, should move the pound significantly. So that is that. So Stelio, I agree 100%.
Steve, you've been talking about the euro and some euro pairs, and we have to remember the big elephant in the room when it comes to Europe, which is Deutsche Bank. And I don't know if you read, they are basically, they have their derivatives books. Books are huge. And from what the Deutsche Bank CFO said today, they are on advanced talks or advanced plans, let's say, to auction some of their equity derivatives positions. And that, as you can probably imagine, will always cost money. So compared to where positions are marked, etc. So having the biggest bank in Germany, biggest bank in Europe, with this situation and potential liquidity issue or whatever is associated, is definitely not a good thing for the euro. We have to remember.
Absolutely. They're not going to let Deutsche Bank fail, but on the other hand, Deutsche Bank has already failed.
Yeah.
Right? And this is clearly depicted on this chart. I mean, if this is not a failed company, a company that was trading in 2007 at $140, and it's currently trading after the recent rebound at $8, I don't know what a failed bank looks like then.
Go back to Lehman. I don't know where they took them out at like $4 or something like that.
You know something, Coach? Lehman was a very successful bank until the day it failed.
Right.
Deutsche Bank has already
failed.
Has already been failing for 10 years. The only reason it hasn't become the new Lehman is because we once had Lehman. You understand what I mean? The reason
right.
That
they
other
own,
banks
they probably owned Lehman's derivative book.
Yeah, and of course they're not going to let it fail directly. I mean, they're not going to, let stock go
too
back
big to fail.
Yeah, it is too big to fail. I mean, imagine what's going to happen if they let Deutsche Bank fail to the Eurozone economy tomorrow morning. I mean, it's going to be massacre. Gold is going to be trading $500 higher within like 2 weeks or something. Absolutely.
But these their derivative book, Stel, doesn't it date back to the financial crisis? They own all that toxic, the CFDs and all those other initials.
I mean, I don't know personally, but obviously it's going to be a legacy book, and it could, they could have basically anything. Yeah. The thing to remember, though, we know people talk about derivatives books being 50 trillion or something like that. It's not the exposure is not that much. There's always
of course
opposing positions. There's always stuff that doesn't, relative value.
The net position is a lot smaller.
Yeah, and you could have relative value positions which really could be $1 trillion one way, $1 trillion the other way, but the net difference doesn't move that much. So it's going to be less, but still it's a huge amounts, huge risk.
It is. It absolutely is. It absolutely is. And we've seen one restructuring effort after the other, one attempt to merge with Commerzbank after the other. We had one negotiation attempt, some years ago, and one very, very recently. They both failed. I don't know. I'm not very optimistic of how that's going to work, especially considering that, rather soon we should be entering the next recession. I mean, everything points to that. And if they haven't managed to put everything in order after a 10-year business cycle expansion, I don't know what to expect during the next recession, right? Especially if it ends up being like a vicious one. I don't know what they're going to do. I honestly have no idea what they're going to do. One way or another, they're going to need to get bailed out. Of course, will they do it directly? As you know, there are several laws that nowadays disallow moves like that. But on the other hand, is there any chance that they're going to let it fail? No, there isn't, because that's going to be the beginning of the end for the Eurozone, most probably. That's going to be the catalyst of something much bigger. So it's a huge mess out there. And I'm certain about one thing. The next few years is going to be very interesting, very interesting. And I think that we are going through probably the last phase of this low volatility environment, at least for a period of time. We're going to have to go to the exact opposite. We're going to have to go to very vivid markets that, high volatility, high ATR markets, big moves. And a lot of people are going to be shocked, because after 10 years, there are a lot of traders out there that have never experienced what a volatile market is. And don't know how to handle markets that have like 3 times the ATR that we have today. I remember vividly when it was quite normal for Aussie USD to move like on average like 150 pips per day. And now you get days with 50 pips and you're like, oh, it moved. It didn't. I mean, it depends on what standards you're talking about. Yeah. It didn't.
That's very true, man. That's very true.
Yeah. So yeah, everybody's going to need to adapt the way they're trading, their leverage. But one thing is for sure, volatile markets. If you know what you're doing are easier markets to trade, because volatility usually creates better patterns. Better patterns give you the ability to have clearly defined trades and not to try to look for an appealing trade within a sea of charts, many of which look uninteresting on occasion. Questions? My opinion, also budget deal could be good for the SPY. Yes, Ziggy says about the budget deal. Yeah, the budget deal, for all the wrong reasons was positive for stocks, negative. The initial reaction from gold after the budget deal was a negative one. I mean, Stelio, go figure, dude. Go figure. I mean, the epitome of fiscal irresponsibility was interpreted as a gold negative. So in essence, putting more icing on the cake of future dollar and fiat currency debasement was interpreted by the market as something gold negative. I mean, I really don't get it. What the budget deal did, which I had no worry that they wouldn't go with it. I mean, they would sign it no matter what. There's no alternative anyhow. Nowadays, I remember the days of the Tea Party, of the Republican Tea Party, that they were they were playing the tough ones having to do with budget responsibility, and they were pressuring the rest of the Republicans to be more rigid, having to do with the way they pressured the Democrats to be more restrained with budget deficit and Obama days spending. Now all that has gone away. Now not even the Republicans pretend to care about fiscal responsibility. So it's a situation that's completely out of hand. I expect the US to have a budget deficit this year of close to 2 trillion. And I'm talking about the real deficit. I mean, the one that you can count by seeing how much the debt is going to increase within a fiscal year, not the reported budget deficit and then another 80% in off-budget items. We're talking about how much debt the US will have to accumulate within a fiscal year to make it through the year. Last year, it was almost 1.4 trillion. I think that if we don't hit 2 trillion this year, it's going to be rather close to that. I mean, 1.8, 1.9, that would be my initial assumption. So, theoretically speaking and practically speaking, all the chickens will come home to roost at some point, and all those developments are definitely going to be very, very positive for anything tangible, real assets, companies with real book value, not companies that are selling services to internet clients that just own like some offices and a few employees. I'm talking about companies that have tangible assets worth a lot of money. So all of that is going to appreciate vastly. But that's something that's going to play out at some point in the future. Let's see how far that's going to be. In my opinion, not that far away. Speaking of the metals, gold still not making the move. On the other hand, silver is just unstoppable. Let's see how it's going to close the day, but it seems to be breaking finally above this trend line resistance. And the next area of resistance is the 127% extension of this last move lower, which comes at 1687. I expect that this horizontal resistance area, 1725, is also going to get hit within, depends on what we see. I mean, depending on what we see from the ECB and the Fed, I wouldn't be surprised if by the end of next week, we've comfortably hit that area. Now, when we see some type of a pullback, I think that's going to be probably a buying opportunity, but let's first get to that. So far, I know that silver is overbought, but trust me, it can get more overbought than what it currently is. Coach, by the way, Do we have, oh, I have questions about pound CAD, pound Aussie. Okay, let's have a look at those two.
Or are you going to ask me if I have a guess?
Yes.
Yes, I do. Peter Goodburn's scheduled.
Okay, perfect. Sounds good. Okay, pound yen, I showed this a couple of days ago, and I said that keep in mind that pound Aussie and pound yen might end up breaking the equivalent wedge concurrently. So far, this theory is still playing out. I mean, today we've seen both the guppy and the cable test the equivalent trendline resistance. But, you know, it's not a descending wedge, and you should not treat it as one until it actually breaks higher. So a little bit more patience. Let's see if it's finally going to make the move. If it does, then yes, I would be expecting an extension higher for the guppy as well. I don't know if it's going to end up making the move today or might end up making the move tomorrow, because keep in mind, you have to also take into account cross-currency effects. So, for example, let's assume that following the ECB tomorrow, we have a big move lower for the Euro USD. That will definitely affect negatively the Euro pound. And through the flows there, you know, you also might see, for example, the guppy getting affected. So the pound catching a relative bid and then seeing some type of a breakout. So keep that in mind as well. So tomorrow might be the day that we see a move higher for those might. You know, we have to wait and see. We first have to see the formation starting to play out, and then we can follow through with that. Pound CAD. Pound CAD. Let's have a look at pound CAD. Here it is. So pound CAD, we were talking about this the other day, because look at this trend line. Look at this trend line. So this trend line dates back to 2010. Since then, it has been tested by the market a few days there, let's say once, twice, 3 times, 4 times. I actually remember taking that trade back then in 2017, that long there. It was a nice trade. I didn't ride it as much as I should. I should have stayed longer, I remember. So where was I? Once, twice, 3 times, 4 times, 5 times, and this was almost the 6th. Bottom line, you know, you don't want to be short against this trend line, right? So, you know, we had a huge move lower, and I was looking for a continuation lower once we broke up below this expanding triangle here. But if you see back then, I drew this line pointing to a move towards this trend line support once again, and we almost made it there. You know, we got hugely oversold levels. I mean, daily RSI made it to like 16. And, you know, we're seeing quite a nice rebound, perhaps even an inverted head and shoulders formation trying to play out here. So if you're asking me, no, I wouldn't be shorting it here. I think it would need to extend higher further before likely continuing lower if it does. But I think that it can easily make it back to 116.10. Okay, sorry, 166.10. I mean, that's what I think about the pound. What you think can happen tomorrow after Draghi? Technical structures look like euro can move up. From a technical perspective, it looks more likely to me that the euro is going to move down than that it's going to move up. But trading is not gambling, so I'm not implying that somebody should position themselves ahead of what Draghi is going to say for any reason. The only reason I position myself ahead of an event, and the only times I do that, is whenever I think that erroneously a market is pricing in an almost 0% chance of something happening, something that has decent chances of happening. And I've seen that on occasion. I mean, it's rather frequent. I mean, I see that happening at least 2-3 times per year. So, when the market is pricing in something for something to happen like less than 5% probability, but I strongly feel that it has, let's say, a 30% probability, then I know that the cost of me being wrong is negligible because the market is already pricing in something else to happen. So those are the only occasions while I'm going to position myself in the market exactly before a market announcement. Now, it's a different thing if I already have a position that is in the money. Then I will just, adjust my stop loss, protect myself, and might stay in for an announcement. I've done that plenty of times, but positioning myself ahead of an announcement, I will only do that for one reason and one reason only, and it's the one I just explained. Graduous management, that'd be great. Switch to government-backed cryptocurrency. Just hope we still have currencies to trade. Yeah, I don't think that cryptocurrencies are going to be the solution for any type of problem of monetary irresponsibility, because cryptocurrencies don't have anything different to offer than fiat currencies. Cryptocurrencies, in essence, are fiat currencies. They're not backed by anything but faith. So the only way to actually solve the problem is use any type of currency as long as it's backed by real money, as it was in the past until 1971. And the only reason that the US convinced the world for the dollar to become the world reserve currency is because it promised the world that by owning dollars, they owned gold, because gold was exchangeable for dollars. Initially, for something like, Coach, do you happen to remember what was the initial exchange rate before they devalued it to $35 per ounce? 50 something, 45, I think, like 45, $50 per ounce, something like that. And then they had, and then before the 1971 event, which in essence they transformed dollars to fiat currency, they had to devalue to $35 per ounce, and then that was it. Nixon had to abandon the transformative nature of the dollar to gold, and that was the beginning of the new monetary system, in essence, a monetary system based purely on faith and nothing else. Yeah, Tom, I remember the 35, but before $35, there was a different rate with which you could exchange. Earlier, there was a different rate, and then they had to devalue it. Anyhow, Coach is your guest here. Coach.
Steve, yeah, the link I sent him didn't work. I just sent him another one. He'll be here momentarily.
Okay, cool. Yes, Nick, exactly that. You just described betting against a biased book, where vast majority of market participants are emotionally biased. That way you get unreasonable good odds, hence an edge. Yes, exactly. That's the only appealing, in my opinion, reason whenever you get on the rather rare occasion to bet before an event on a specific outcome, not because you think you can guess the outcome, but because you are pretty much convinced that a specific outcome has a much higher chance than the market is pricing in to happen.
Okay, Peter's here.
Perfect. Okay, enjoy the interview, Coach.
All right, buddy. Thank you, Steve.
My pleasure.
Okay, Peter, I'm going to make you a panelist and unmute you.
no promotion joke today, asking them when was the last time they got promoted?
Nah, I only tell a joke 1,000 times and then it gets old. You know what I mean? So I think, Peter, can you hear me?
I still don't see even a microphone next to his name.
Yeah, I don't either. That may be, I think I asked him. Okay, that may be an issue.
Yeah, not having a mic might prove quite an important problem, right?
Well, how did they do it before in GoToMeeting? Didn't people need a mic?
We had a few guests, not a lot, like 4 or 5 guests that were actually calling in. Now there he is. Now I see a mic. So
okay.
I just Dale, can you hear me?
Yeah, you're here, Peter.
Hi guys.
I was worried you didn't have a mic. You know, a Zoom. You need a microphone or something to be able to talk.
So Peter, the next step now is you mouse over the Zoom panel. There is like a green button saying share.
Sure.
Yeah, using that, it's going to ask you if you want to take the screen away from me. You say yes, you choose the screen you want to share, and that should also give you screen sharing.
Okay, I'm just going to select. Will it give me the selection for which monitor?
Yeah.
Which screen?
Yeah, when you click the share, it'll show all your screens.
Yes.
Great. Okay, let's have a look. I think this is the right one. Let me just check.
Yeah,
coming up. All right, so
okay.
Yeah, we have the S&Ps here, bro.
Oh, great. Okay, thanks, guys. Well done. Well done.
All right, great to have you back, Peter.
Thanks.
So I guess we could start here in the S&Ps. I do want to go to Euro with Draghi being here. So 30.23. That was a high. We've traded 61.8 back off last week's high, I think, and is the approach here that we shouldn't take out? I think it was 30.19 or so, or are you looking for 30.23, one more new high?
No, I don't think it should make a new high, to be honest. It looked as if the structure within this final leg for wave C, this is a zigzag, by the way, moving up from the lows we've got here down in early June. So we come up wave A, here's a tiny retracement for B. Don't see that too often. But the very noticeable aspect to wave C is very distinctly different to wave A. We have 2 types of impulse waves in Elliott wave theory. We have an expanding impulse, which is what this looks like in wave A. So it's pretty vertical.
Yeah.
And you normally get an extension in the third wave. I think everybody's familiar with that idea.
Yeah, the money wave.
Exactly. And then you get a diagonal impulse, which is this sort of like wedge-shaped thing, where you get overlap as well. And actually, we've got a shorter-term chart here. You can see a bit better. So here's wave 1 of the diagonal up here into mid-June, and then you get a retracement, and then you get 3. And then the retracement in 4 sort of briefly overlaps wave 1, and then you get the 5th wave. So when you count the subdivision of that sequence in 5 waves in a sort of wedge-shaped type process, it should have already been completed. So I would be very surprised if we took out 23.5.
Okay. All right. So pretty nice risk reward. No one, I talk about the VIX, and no one wants to buy insurance. A lot of complacency, but not the same type of euphoria at these highs that we had at the last high. That showing up in some put call stuff. So it looks like we're going to have a Mueller high here. He's speaking now, failing rally. And that's a pretty deep retracement. So if people aren't enthusiastic about risks now, they're certainly not going to be should we attain your objectives of 2,700. So it's a roadmap. This is a 4. And then after 2,700, we blow off to new highs again, Peter?
Yeah, I mean, actually, this movement down here back in December was, of course, 2018's correction, wasn't it? And that was sort of this pattern here, the longer term situation. We unfolded here into this hybrid expanding flat, I call it, and this big swing up, we've just been looking at just now is wave 1 of intermediate 5. So if we go back even further, we're on track to get to the 4,400 number, which was our forecast. Can you believe that was our forecasts about 5 or 7 years ago?
I thought you were crazy.
I thought I was crazy, but because but the thing is,
well, my mother would say, in an era that you have to pay someone to hold your money in Europe, that it's turned into, it's a Yiddish word, a mashugana world. Crazy world, bro.
Yeah, it is. Well, when I speak to my mother and she gives me advice, I have to go through a medium. But anyway,
me too.
And yeah, right. And generally, they have a crystal.
I have some clients that will be looking for me in that stage too. So okay, so the bull market alive and well.
Yeah.
Okay, and that's a very interesting thing. Do you have any feeling as far as how much time to complete all this? Is it going to go into the, we have Mueller talking today. Is it going to go into the election 2020 and beyond? I think you were looking for everything to kind of be okay until like 2021 or so, Peter.
Yeah, I think there's
equity-wise.
There's a 94-year cycle. I'm just going to pull it up. I think I've got it here. It's on the Dow. It's just come up on another screen. I'll just give it across.
Yeah, where we would begin the generational bear market. 23.
Yeah. Wow. I mean, this is 94 years between 1835 to 1929. So
okay.
So if
is
we
that
just
Kondratiev 1.38 or
well, it's just, I don't know, 94 years. I think that's probably a planetary interrelationship.
Okay.
I'll have to check. But
I don't know. This pretends to me that President Trump's going to be reelected. I just can't.
I would think so.
I just can't see us getting to 4,200 with a real progressive agenda of it. Trying to take all the money away from Wall Street and redistribute it. I can't see how there would be a 4,200 Dow. Do you think that this move of having Lagarde replace, and I know you're more of a technician, but I know you think about these things. So what does that mean to you that Lagarde is going to replace Draghi?
Well, I think that they're much out the same pea pod, really, to be honest.
Okay.
There's not going to be too much change from what I can see. I mean, she's always
kind of like a reorganizer. I mean, she specializes in countries going bankrupt. Maybe they need that type of person for some type of restructuring in Europe.
Yeah, well, don't forget she was the French finance minister, wasn't she, in the past?
Yeah, that's right.
So she's got a sort of hopefully she's got a math degree,
right.
But I don't think she's got sort of intense knowledge about the mechanics of monetary policies and things. I mean, obviously that means that she's going to come with her own take on the situation. But when I said she's out the same pod, I think it's mainly because she recognizes that there is a need and assistance from central banks to help economies. They still go through this Keynesian sort of idea of economics where you've got to sort of flood the money.
The only person that actually understands monetary policy better than anyone at the moment is Bernie Madoff, and he's in prison.
Yeah, he got caught doing what we've been doing for
decades. You're right to say that, because in a way we're living in a Ponzi scheme. There's no doubt about it. Did you see that last week or earlier this week, the Chinese launched their Star exchange on the Shanghai Stock Exchange? And
actually I did. I read an article in Financial Times. It was crazy.
That's right.
How the market moved.
Well, it was incredible because 24 the initial 24 stocks that were listed, they were producing something like 155% returns from a sort of a launch on that platform. There's going to be more over time launched, but the PE ratios are are huge. I mean, one company was something like 200 times its earnings, priced at 200 times its earnings. 200 times. I mean that's sort of normally bubble territory.
Yeah, that's .com territory.
I mean, that's really ridiculous. So when we look down the pipe,
Pets.com. Pets.com. Do you remember it?
Yeah, sure. Anything with a .com was worth $1 billion.
Yeah.
So, Peter, let me ask you this: with this happening, and I know that I want to give you credit. Part of the reason I was negative yields, that yields were going to head lower. And then, I've been trying to bottom pick them a little bit here. Bonds are making new highs. I remember you talking about 202, and then you were looking for maybe some type of bounce. Will work for food.
Couldn't resist it. Sorry. This is circa 2000, by the way. This is circa 2000. So this is 18 years old. So I don't know what we're going to get.
I work for, I don't know. They have this new IPO, something about meat, fake meat. I don't know. It's all these IPOs. I mean, Uber, Peter, said they don't expect to be profitable ever.
Sure.
Ever. Okay, so we're going to 4,200. Is that going to be spurred by lower rates for longer and central banks? Do you think that the Fed, if we get this correction, I'm sure they're going to be cutting, if you're right about a pullback to, I think you were looking for about 2,700. Fed would get aggressive down there. Don't you think that's where they use their bullets?
Yeah, I think so. I mean, it's inevitable that they're going to try and help. I mean, obviously, you've got the one hand, you've got Powell, who's very reluctant to appease Donald Trump's ambitions to try and get interest rates down to zero.
Yeah.
And so therefore you can't take him for face value. I always said that the Fed are very reactive; they're not proactive. And I've written a few articles about that in the past. And I believe that will eventually be their undoing, because if you haven't got anything to really surprise the market under financial stress conditions, then you're not going to be able to convince people to. I mean, it was a very good exercise. Don't forget, back in the financial crisis lows in 2009. But if you're running to a dot plot scenario, which everybody can see, and the central banks are insistent upon it, relying on the data, they see everything just as we do. The only big difference is that we, as market traders, have a bit more acumen in recognizing when trends change direction, and therefore that means that we can be a bit preemptive, but the Fed can't. I tend to think that this particular chart I'm showing now is the 10-year Treasury yields. It's our current forecast, and
right. Okay.
We've tended to. I think at the beginning of last year, we could see that the markets, the yield was topping out. It was about to change direction, and it was about to lean over. And we had a target.
The last time you're on, you're also very bearish copper at the highs, and bullish Bitcoin near the lows. I mean, you're anyone just go back and play Peter's last interview with us, and some very prescient calls, Peter. Really, So let me ask you something about this 170 target, because I mean, that's 20 bips or so under the recent low.
Yeah.
So that's still above the historical low of 135 on the 10-year.
Yeah.
So
absolutely.
it's going to be a higher. It's going to be a higher low in rates. Is that going to signal what could be the end of this bond bull market, since we're not going to confirm and take out 135 now, and that after 170, the biggest surprise would be yields going up, yield curve steepening, while the Fed is still easing?
Absolutely. I think that's going to be exactly the scenario. And we haven't talked before this interview today. So and our thinking are very much aligned, because I was updating some of the short end of the curve, especially the 2-year. If you look at the 2-10 spreads in dollars, that's flattened out to very low areas, but that's going to steepen. That's going to start widening quite dramatically next year. Not this year.
That's going to be good for the banks, huh?
It's going to be good for the banks. The banking stocks have been hit badly in the last 2 years. They're going to start recovering. And don't forget, the stock market is a pretty good bellwether of what's coming, because we looked at the S&P a short while ago, and the bigger uptrend is still very much in play. So you're not going to see a protracted decline in the long end of the curve. This, I think, will bottom. It might exceed 170, but ultimately, I doubt if it will get too far below that, because we're defending basically this low. This is the one you referred to. We're defending that also on the 30-year as well. Let's have a look at the 30-year.
Yeah, I noticed the 30-year has a little better construction than the 10-year. That's why I thought the yield curve would steepen, is because the 30-year recently has been a little stiffer than the 10-year.
Yeah. I don't think that this is any way going to break below these lows. Certainly not.
Okay.
And this is obviously a forecast down to 230 this year. But in principle, if you look at those aspects, then that tells us, yes, we definitely should be looking at a bottom around year end. And at least before then, stock market, this S&P drop is about 11%. I think it's about 17% actually on the NASDAQ. So that should underperform as it did, obviously, pre-December. Last year during the October-December time.
What does it? Go ahead. I'm sorry. Go ahead.
So that all sort of gives us the impression that this is going to bottom before year end. Copper's going to bottom down here. Oil's going to bottom, and then they all get the next big shove in the inflation pop. This idea of an inflation pop is something that I coined a phrase in 2010, which was basically responding to the fact that the central banks around the world, particularly the Fed, were inflating asset prices, and the typical sort of inflation pop pattern, which I'm writing about constantly, and we're just publishing in our trilogy video series. If anybody's interested, I'll tell you about it later. But the inflation pop looks a bit like this. Now, on the left-hand side, you have the financial crisis lows in 2009. Yeah. So things like copper, oil, emerging markets, they all went up in 2000 to this peak in 2011.
When the dollar was weakening.
That was correct. And then the dollar strength came back in, and we started to see this dip in emerging markets, commodities. That was the low in 2016. At that point, the big 5-wave pattern in stock markets was about here in 2016. And then the stock markets continued to move up, and we started this run up from 2016. And this is where copper, for example, topped out in 2018.
Okay.
Yeah. And the emerging markets as well. Also, a lot of the Asian markets like Hang Seng topped out there. And we've been locked into this correction, and we're still missing a little bit of a leg to the downside. That's why copper is forecast lower into year end. The S&P is forecast lower into year end.
How about gold and silver? Have they peaked?
Well, no, I don't think they have.
One more push up, and then they catch a little bit of the downdraft of this final push up in the dollar, because I do want to get to the dollar and euro, because you had a great number that you never really came off of, was 99.20 to 102 in the Dixie. We're we could be there in I don't think that would take till year end, would it?
No, well, I think the dollar index, it started to break up yesterday.
Yeah.
And you can see it here. It broke up.
You know what a friend of mine called the chart of, he's not an Elliotician, it's kind of although he knows Elliott Wave. In his letter, he wrote I have a new name for the formation in the dollar index: unintelligible. So he's been doing this 40 years. So can you be intelligent about the dollar index with all this?
I'll certainly try. I mean,
okay.
probably zap a USB stick into my head. But
Yeah.
actually, I've actually had quite some success in calling these movements up and down, because we could see that there was an expanding flat pattern developing from here. Can you see this March high?
Yes, we got it.
Okay, you drop down in 3 waves, you move up and break the high briefly in 3 waves. So this is a 23% extension. Then you're supposed to drop 5 waves down. Well, it gets a little bit tricky, but basically it's a diagonal ending here. I actually thought at the time that it would extend. I mean, an expanding diagonal should have extended down to this level.
Yeah, we're looking for one more dip that didn't happen.
It started to move up. Yeah. During this phase, this developed higher in 5 waves, and that gave us the clue. Okay. This was a contracting diagonal, but it finished a bit earlier. So it's technically what we call in Elliott wave a running flat. And that's the clue. And this is 5 waves up. This is a sort of 3-wave correction of some sort. But it's breaking the high yesterday. Now, there could be a little bit of a dollar dip here, but not very much.
So I'm kind of getting the picture of the whole jigsaw puzzle now. So dollars, let me see if I have it. Dollar strength until year end, commodity pressure until year end, bond yields down until year end, and then everything flips.
Everything flips, yeah. So after that, you've got the next.
I hope Santa brings me about 50K to trade this year. That'd be a perfect time, huh? Santa, how about staking me for 2020? I know it's going to happen. That'll be my letter.
You should be able to. Yeah, you should be able. Well, you should have made a lot of money on Bitcoin this year. So I mean,
that was a great call. I got out so early. I bought a Royal Trust called GBTC. At $4, and I actually timed it very well during that pullback that we had into the Feb low, and got out so early. I mean, the thing went to $15, $16, and I got out with a double.
Okay.
So I don't know some of these moves. I want to talk to you about this, Peter.
Well, I mean,
it's one of the hardest things for me to do is to have a good hold. How do you hold?
You've got to grind your teeth out a bit, because I had various clients saying, look, should we cash in on Bitcoin? I said, no, don't. Actually, one of the hardest things to learn in Elliott wave is to really hold into a major long-term trend. I mean,
in any discipline.
It is. I mean, the only thing is that if you, what I find personally from Elliott wave is that if you distill yourself, it's all about self-examination. If you make mistakes, go back, have a good look. I mean, look, nobody likes to admit defeat or to be proven wrong. But if you do make a wrong trade, try and face the mirror and look at yourself and say, well, can I improve next time? One of the hardest things for me to learn in my career using Elliott wave was actually to maintain yourself in amongst those bigger trends. It's one of the hardest things to do. Because there's always going to be...
Because you see so much short when you go micro. Here's my self-talk. Well, I could take it here. It's stretched. I know there's going to be a pullback. Yeah. And even if there is one, it wasn't deep enough for me to recommit. Or I was focused on some other positions. Yeah. And I would turn my head and it would get away from me.
I know these are the everyday things that we have to encompass and get over. But I was absolutely steadfast during the 2016 advance, because we had this grand resynchronization lows that I showed before,
right?
Where
I remember
everything came together. The stock markets dropped in 2015. They hit the low in February 16. Right. And we had that as the emerging market. I mean, the analysis in the emerging markets and commodities all bottomed at that time. We knew there was going to be a really, really long, protracted upswing from there. And I remember in my early career, there was one guy sitting on the sales desk opposite me, and he had an IQ of about 50. But the good advantage of him was the fact that when he told a client to buy it, I mean, he probably flipped a coin in the morning before he came in the office. But when he told a client to buy it, if it went against him, he just said, keep buying more. And I was astonished, and frightened by this guy. He scared me. Yeah. But actually, a lot of the time, with luck or judgment, actually, he was right. and he wasn't getting swayed by I was joking about him years later, but actually it taught me a lesson. And you've got to be steadfast when you see these bigger trends move. But the only thing is that in order to garnish your conviction, you've got to do the work. You've got to put everything together so that you're absolutely convinced there's not any glint in the armor where a knife can wiggle in and throw you off course.
I got a great tip, Peter, and teach this because it has kept me in some trades. It's the only thing that I have it written down. So when you're about to take profits, you ask yourself, would you reverse here? And if the answer is no, you walk away and let it work. Let
it go. I mean, I've just shown I flicked a couple of our charts that we did this year on Bitcoin, and you can see that, you could see that this, if you've got a pattern like this, 1, 2, 1, 2, and then you've got all these little bits going on.
Yeah, I bought that pullback into February that you have labeled too. Yeah. It was 78.6 back from the initial pop.
It was perfect. And when you start getting all these little things going on, and you see you got 1, 2, 1, 2, but then the next 1, 2s are compressed. They don't break.
I got out on the April Fool's joke. It blew up on April Fool's.
Yeah,
right?
It came up there.
Yeah.
I mean, as soon as you get that, Now, what I tend to do as a marked measure is I always extend a series of 1, 2s by 1, 6, 1, 8.
Okay.
And I try and allow the market to expand to those numbers. Now, originally, when I did that, we were getting numbers up, I think, towards this number up here. So even during this phase, and we could see this as a correction, we thought, no, this has still got lots more to do. Just keep going because this thing will expand. And also I'm working in log scale, which is also a very big plus, and I keep telling all of my clients and anybody else who's willing to listen.
It's interesting. You have a target near where I have some lines at 7,500 about.
Well, this was coming in at the time, a bit of congestion, and then this rally. And I'll show you the next chart after that.
Oh,
and then, of course, we could see that this was getting into those numbers. I used a 60-1/8 correlative ratio. I measured 1 to 3 here, took a correlative ratio, added to 4, which finished there, and put up that 13,712 number. And then before you know it, you're there. And we got to 13.8, not 13.7, and then we saw this 25% drop. Even the rallies are sometimes working. Now, in previous years, when I looked at Bitcoin, there were lots of gaps before this IMM contract came on board, or CBOT, whatever. And there were lots of gaps. The patterns weren't running very nicely according to the Elliott process. But now they're actually working really well. And I think that's down to the fact that we've got a major exchange where it's traded. The institutions are getting involved. And I'm seeing a lot more conformity to the patterns. Here, for example, was a rally in wave X to 12.3. And within the next day, you had 12.4.
Nice.
12.3 number. You can't, there's a fingernail difference. And then suddenly, bang, we're coming down. Right. So the patterns are pretty good on Bitcoin. So if you are trading it, we've got some great new updates in our currency report. We're just releasing that today.
Cool. Can you wrap it with look at gold and silver?
Yeah. Let's take a look at gold. I still think that gold is going to attempt a little bit higher. I'd love 1523 to come in. I'm not sure if it's capable of doing that because of the dollar position at the moment. But it's shrugged off the dollar several times in its recent push up. And I think that if the stock market were to suddenly drop, there might just be enough people with a gold inclination at the moment to go in and buy more gold as a bit of a hedge, because people are talking about it being more of a hedge than they've ever done before in the last 2 years.
Okay.
So, but the main reason why I don't want to be around for this for too long on the upside is because there's a gold cycle, which I'll show you now. It's a daily gold cycle. And it shows that we've got a peak in about August time coming in, and then it flattens off into September, and it starts to drift off. And so I think that, some of the sentiment indicators on gold are a bit high at the moment. The net speculative long positioning is a bit high. And I can see that if we did thrust somewhere anywhere towards 1500 would be a satisfactory end.
Yeah, I was thinking about 1480.85 or something, but yeah. Okay.
Somewhere like that, yeah.
And silver is what's that chart in? Okay, that's gold and silver. Really, I'm sure you pay attention to the gold silver ratio. I was seeing it topping out at about in the 90s, and said one day we'll look back and go, why didn't we sell all our gold and buy silver?
Well, yeah. I mean, the gold silver ratio historically, I mean, if you're in the 90s on the gold silver ratio, I mean, think of it. You've got 90 silver coins laying on your table in front of you, and you've got one gold coin.
Yeah.
Now, if you throw anybody in, and look at the physical coins in front of you and say, right, what do you want, one of them or 90 of those? I know what I would choose.
Right.
I mean, if you had to use...
Because the mean is like usually having 40 or 50 of them.
Well, it's not so much that. If you wanted to break that single gold coin into 90 singular pieces, how would you do it? I mean, if I want to go and buy some bread down the road,
Are you an alchemist too? I mean, what a renaissance, man. So Peter, every time you come, you give me clarity of big picture stuff that I could use my stuff for timing your ideas, and you've really helped me make money over the years, and I'm sure everyone who listens to you, and that includes times that you're not right, because that happens too, but you're really there's something about the way you also present your work that gives people clarity when they listen to you that they probably don't get when they just read a letter. But I know you do video series too, so this would be a great time to show your website and how people could get involved with you.
Oh, great. Thanks.
Okay, buddy. It's commercial time.
Okay. Well, if anybody's listening and they're interested in what we're doing, and we're doing quite a different look at across 4 different asset classes. I'm sure that we're looking at something that you're trading already, and our short-term updates are published twice a week in the Elliott Wave Compass reports, and you can actually go onto our website. This is wavetrack.com, and if you want to read about the Elliott Wave Compass report, click here, and you can read about it. And then if you want to order the Compass report, you can go here. So that's one way to get a really good, concise idea of some of the shorter-term trends, like Bitcoin, for example, all the current major currencies. And, of course, the stock markets, the S&P, the Dow, the Russell, and the NASDAQ, and also the European markets and some Asian markets too. Now, in the last month, we've been publishing our video series, and this is really great because these are the longer-term charts. I mean, we often get clients saying, well, okay, you're publishing the Elliott Wave Compass twice a week. We want to see the bigger picture a while to give us some perspective. Well, now's the chance to do it, because this is part 1, which we launched in June. This is stock indexes, and this is our blog. Actually, you can go back to wavetrack.com, and on the top right-hand side, you can click on the news alerts here to look at those. So this is part 1, which is stock indices. And then we have commodities, which is very extensive. I think that's probably our biggest report of the 3 out of the video series. And then you can click on the currencies report, which we're publishing today, actually. So,
wow.
This is
right hot everything.
It's right hot off the press, July 24th, that's today. And I've written a nice introduction to the way it is. I've picked up some stuff with courtesy from Market and JP Morgan, which relates to the inflation pop and the way that the dollar's going to react from that. So if you want to order that, you can see details there too. So there's a couple of ways in which you can log into us, and we'd be happy to welcome you into our fold.
And that's www.wavetrack.com?
Certainly. This is our main website, and then you can get to the blog by clicking on any of the links over to the right.
Okay, and your Twitter handle again, Peter?
Our Twitter handle, you always ask me that, and I'm never prepared for it, am I?
Yeah, you're not that active on it. It has a hyphen in there. It's
Well,
Elliot
actually,
Wave